Hello friends, once again I welcome you back to the channel. So today I'm back with another video, and this is episode 4 of our institutional trading series. This is episode 4. You can check out the playlist. It is called institutional trading, in brackets SMC. You can check it and then watch from episode 1 basically. So we are talking a lot about price action, and there are a lot of things that we are talking about. So far, we've talked about consolidations, we talked about the impulse moves, and then we talked about imbalances, and then we also talked about fair value gaps. So each one of those videos is addressing any of these ones. So I recommend that you watch them. If you watch them, thank you. So basically, I told you for fair value gaps, these are the gaps you get when we see these large body candles, or any part of the body candle that is not violated by a candle wick, you get. And then we can also look at this as an imbalance. I told you, there are those moments when the market is consolidating, when it's most times when it's going sideways, you get. And then there are those moments when we get large displacements or impulse moves, as we can see that trigger the market to leave one area to go to another. For instance, we left this consolidation here, and then we came down, you get. So basically, and then I told you, when we are getting a consolidation, this is like a stage of creating fear, you get. This is a stage of where the market maker creates fear, and here they create greed. So at all moments, we see that sometimes it's really hard for us to know where the market is really going to go, because almost each and every candle has a part of fear and then greed. So I want us to be utilizing the parts when the market is creating fear, and then will be part of the distribution, all these impulse moves that happen in the market. This is the best time you would wish to go in the market, because here the market is living, and then we see that when we are in displacement, or we get these large displacements, most of the time we get imbalances, you get. So we expect the market at one moment to come back and fill up these gaps that they've created, you get. So that's it. So basically today we are going to be looking at supply and demand using discount premium theory, you get. We are going to use the discount premium theory. So the topic of today is supply and demand, and I'm going to show you what we mean by discount and what we mean by discount, and then what we mean by premium. So basically I have some simple illustration here before we go back to the charts, you get. So the simple illustration is here. You and me, we are retail traders, you get. We are retail traders, and we have our accounts with a broker, your broker that you're having, you get. Because, by the way, a quick reminder, we are going to use an example in synthetic indices and then for forex, so just stick around. Then when we place our orders, we place our they are filled by a broker, you get. So which means there is someone who provides liquidity, a liquidity provider. Now, a liquidity provider is that person who is willing, if you buy, who is willing to give you money, you get. If at all you place a buying entry and the market goes your way, and then, which means these people are so important. Likewise, brokers are important, you get. But basically brokers connect us to liquidity providers. Now the liquidity provider is in the business to make money, not to give out free money. Likewise, the broker also uses the spread to get off a commission, you get, to make off money of your investment that you put in, you get. So the liquidity provider also brings in money to make money, you get. They invest money to make money, you get. So which means it's really important for us to understand these things, because we want to be part of those movements, you get, of those movements that leave this, let's say, this place to this place. Why? It's because here market makers or large institutions, as always say, they're the ones that have the capability of bringing in a lot of money. I told you, if you Google, you're going to find that the forex market is estimated to be around 6 trillion trading volume per day. You get. So for 5 days. So if at all 6 trillion US dollars are flowing into the markets, that's a lot of money. It's not provided by just people with 100k accounts. You get. So which means large institutions come into the market to make money, and they bring in a lot of money. So it's good that you're here to learn, you get. So basically that's it. Then this prompts us to to apply some business perspectives or some business principles as we trade. You get, as we trade. So basically, that's why the theory of premium discount comes in. You get. So which means, just suppose yourself, like, just look at this yourself. If at all you are in a business where you're reselling products, you get, you go and look for products where they are cheaper. You get, where they are cheaper, and then you sell them more expensive. For instance, if you're reselling t-shirts on, let's say, there's this site called uh, Shopify. You get, if you're reselling t-shirts on Shopify, which means if you're selling them for $30, maybe you have somewhere where you're purchasing them at $20. You get, at $20, you incur expense of about, let's say, $5, so that in the total, each t-shirt is costing you, let's say, $25, and then you sell it at $30. You get. So which means, if at all the market is willing to sell like quite significantly, you get, if it is willing to sell, they will have to come and tap into premium, and then they go into, like, they come down, because here like, basically, that's it. You get, if you wanted to resell. So if you wanted to buy, if they wanted to take the market up, cheaper prices are down, they come and tap into prices down. You get, and then they come and make a profit up. You get. So I'm going to be illustrating this on the chart. So basically, the premium discount theory divides the market into two. You get. So that's why we have a 50% level here. So basically, this, we can use a Fibonacci retracement tool to help us identify those levels. This is level 50, which divides the market into two. You get. So which means, as we are willing to buy, that's why almost each and every candle has a candle wick. The market starts here, it drops into discount. For a bullish candle, it drops into discount, it gets into premium, and then they close it. You get. So the next candle starts in discount, goes into premium, and then they close it like that. You get. So it explains why we see those candles having those wicks, if you're really keen on how these candles really move. You get. So basically, that's what I wanted to bring out. So we are going to be illustrating this a little bit more on the charts. So let me first go to Euro USD here. You get. Euro USD. Even before I zoom in, you can see that we have this large move that happened from this area up here. You get. So I want us to be applying the premium discount theory to see whether it's really applicable. So you can see that we got a shift in market structure here, and then we broke structure. You get. So you can see that maybe possibly the market makers are willing to take the market bullish, or to buy the market. You get. To buy the market. So where would they be willing to where would they be willing to place their orders significantly, because you may not be part of this move that really started here. You get. So I'll be making more illustrations on the same in the next episode, but then let's try to apply our premium discount tool. We are using the Fibonacci retracement, and then we're trying to measure off. So what's really important is that I want to do this. You get. So you can see that we got a shift in market structure. You get. So most times this is what we call, we break and then we retest. You get. So we expect that we are getting a pullback, but until where? You get. Because we don't know exactly where the pullback is ending. So if at all the market was coming from top here to down here, where would your take profit be? Because it's really possible that we can trade the trend. Let's say, if at all we've gone through this place and then the market shifts, it turns down. You get. Where would our take profit be? So we can utilize these points from this point to down here. You get. And there's a reason as to why we also just ended at this point here. You get. There's a reason as to why we just ended at this point here. You get. But then we shall see that in later episodes. So now you can see that the market came down. You get. It came down below this level, below level 50. You get. For a bullish market, we can see that it came and tapped below level 50. You get. It tapped into discount. You get. And then they come and make a profit. You get. They come and make a profit. So let's delete let's delete this Fibonacci retracement tool. So the market goes up. You get. And now it's coming down. So I want us to be identifying. Tomorrow we are going to be looking at order, maybe tomorrow, but in the next episode we shall be looking at order blocks. Where exactly those zones exactly where we expect the market to be stopping. You get? So this is the next point. So you can see, which means order blocks are going to be lying below level 50 for a bullish market. You get? For a bullish market, most of the time we are going to find order blocks below level 50. You get? So you can see that even here, the market, as it moved from this point, when you measure this impulse move that went, you get? These impulse moves, we are measuring off where the pullback will end. You get? Where we expect the pullback to end. You get? So you can see that each moment we tap below level 50, then the market shifts. So which means if you're good at order flow, if I told you were observing these zones on a bigger time frame, for you, you would see a reversal here at this point here. You get? You would get a reversal at this point, just over here. There is a tool that I want. So this is what I wanted. So which means on small time frames, you would see the market reversing and then it goes up. You get? It goes up. So let me delete this. So we can see that as the market moved up, we can see that we got a shift in market structure. Still, the market broke down. So for us, we may not be part of this move that came down, but we want to be part of this move, let's say, that happened from this point. You get? And then at least we can get in here because we've already gotten information or confirmations that the market is selling. But where are the zones? Where exactly should we get in? You get? Because I told you, in trading, we base on what has happened in history to determine where the market will go next. You get? So we have to be really keen. So even here, let's apply our Fibonacci retracement tool. You get? Or any tool that can divide the market into two. You get? So you can see that 50 is here, and then you can see that here the market tapped into the premium side. You get? It tapped into the premium side, and then we started getting into a bearish market. You get? So this will be, you're going to find that this theory works many times. You get? It works many times, but it is not the only reason, or it is not the only tool that we can use for reversals. You get? Let me show you an example. It happened on gold. You get? It happened on gold. So you can see that even here on gold, we got a reversal. The market moved from this point up here, and then we can see that we were getting pullbacks. You get? By the way, these are signs of what we call a complex pullback. You get? This is what we call a complex pullback. Most of these things, to be honest, as I always say, I mention them I go in detail in my mentorship program, but these could be the signs. Let me quickly show you. So we can see that we got a shift in market structure here. You get? But then let's apply. You are going to measure from this point here to up here, because we can see that the market didn't reverse back to this point where possibly would be looking for this order block. You get? The market to tap into this. Would have expected the market to come and tap into at least this candle here before it started to buy. I have many of my friends, my fellow traders, who are expecting gold to first come back here. You get? And then we buy it aggressively, because most of our confirmations were showing that we are buying. But we can see that we waited until maybe we actually got in after this consolidation to go up. You get? Because we didn't reverse here. But what's really important is that let's try to use our premium discount tool that we're using, which is the Fibonacci retracement tool. You can see that the market moved up, but we never tapped into discount before we bought. You get? We never tapped before below level 50. You get? So not always. There are those rare cases when the market will not tap below this level. So now, which means the premium discount, much as most of the time will provide you with entries, it is not the only reason, or it is not the only confirmation for you to get in. We can see that the market here, I reanalyzed here, and actually it was my first time tonight, is that we broke two levels. You get? So which means would be targeting this one. You get? Which means the order block was lying here. You get, the order block was lying there, but now this one is at an advanced stage. You get, so basically in trading, sometimes there are those missed opportunities. You get, there are those missed opportunities, but sometimes you reanalyze. You get, so we were waiting for the market to get to tap here, but then we overlooked that the order block, or there's even a fair value gap here. The order block was in this region where the market, where actually the real demand area was here. You get, so which means we had to get in here to buy, but then we got in a little bit late at this point here. You get, at this point here in this region. That's where we got in. But still, you win some and sometimes you lose some. Not because you've gotten in negatives. Here I would have been happy if at all the market came here. But it provided me with an opportunity to learn that not always prices buy at discount. You get, and not always prices sell at premium. I believe now you know. You get, we, this is premium up, and then discount is below 50. Above 50 is premium, below is discount. So now let's get an example in synthetic indices. So for synthetic indices, this is what we are going to use. You get, this is what we are going to use. Now we can see that VIX 75, actually in my early days of this channel, this I made some analysis on VIX 75, and then we turned here. You get, someone was asking that time, I remember, was asking what was going on. Are we still buying or we are selling? So from this time, from this moment, VIX 75 sold aggressively. I'm happy. Actually, we're on the daily time frame. I'm happy that many of you, you would watch my videos right away, and then some of you took entries and you were making money. But I stopped doing those things on a regular basis because it was not really the best way of you getting signals. Sometimes it would be really tricky because there are days when I would give selling confirmations. Yes, eventually would sell, but even these candles, given that these are daily candles, there are those moments when the market was buying. So it was really risky for you people to be taking those entries. You get, those entries. But now my main focus is that we can see that the market moved aggressively. You get, impulsive. You can see that really, if I told you had gotten in anywhere here, you get, anywhere here, you get. Let me show you. If you had gotten in here and then you were still holding, because even later on I came and reanalyzed. If you go on the weekly, it's only that on TradingView you cannot go on the weekly time frame. But this is the zone where this was the, this was target about, this was, I think, target 3. You get, this was target 3 of my prediction, of all of my analysis. You get, so basically target 1 was target 1 was target 1 was here, and then target 2 was here. You get, and this has been target 3. You get, it's been target 3. But mainly my interest is just is on using premium discount tool, the premium discount tool. So you can see that here we broke structure, or for many confirmations that have been, by the way, I'm only mentioning we got a shift in market structure because in many videos I've talked about how the market really, or some of the confirmations that we get when the market has gotten a shift. You get, that's why I'm just mentioning we got a shift in market structure. I don't want to over repeat myself. You can be watching my previous videos to look for those for that analysis. You get, so we can see, so we are going to measure off from this point to this point. You get, where we got a pullback. So basically, what am I interested in? You get, we get a shift in market structure and then we are getting a pullback. You get, so I want us to be identifying a zone. You get, I want us to identify, actually, I want us to identify that zone where the market really is going to shift, because we know this is just a pullback. You get, so if at all this is the daily time frame, where would you jump in and where would your take profit be if at all you wanted to benefit from this move that is just running from, let's say, here to this point? You get, because I want us, if I told you know where the market is going to end for the pullback, then you're good to go. You get, you're good to go. You can even benefit from buying to this place, to this zone, and then you sell here. You get, so basically, let's apply. So we are going to use just this tool that divides the market into two. You get, so Let me even zoom in a little bit further. You get? So by the way, you guys, sometimes good information is boring. Some of you look for entertainment. I don't recommend that. So basically, you can see that the market. If I'm to use an arrow where we ended exactly, you see, this is what I wanted to show you. The market came and tapped slightly into the premium side before we sold. You get? Before we sold. So now, given that this is a higher time frame or a high time frame, when we mark out this zone, you get? We go on a smaller time frame. We go on H4, we go on H1, we go on M30, and then M15, and sometimes M5 for our refined entries. You get? So basically, I will not go on those small time frames, just not to make this video so long, but you can see that we got reversals. We got reversal patterns here, and then we could be part of this move that was selling. Now, what am I interested in? If I told you got in on a sell here, it means you're going in for big profits. You can hold your trades because you know at least this move that is going to come down is going to multiply to this move from this point to this point two times. You get? You get? So basically, most of the time it's going to be two times. You get? If you don't know where to place your take profit level, you get? And then by the way, you go and backtest this. You're going to find that if at all we sell, you get, and then we are selling from a premium from premium side, the reward always most of the time is two times the length of this pullback. You get? So we shall get into that maybe in later videos also. So you may be asking yourself, you backtest this. I always like people who backtest the things that I give out. You get? And now let me show you one more illustration about what is happening currently. By the way, now if you wanted to know, for me right now, my overall bias for VIX 75, we are still on a daily time frame, is to buy. You get? So basically, we got still reversal confirmations. You get? But basically, by the way, you guys, if I'm sharing these things, always go on small time frames and then you do proper analysis there also. You get? So we are going to measure off. This is going to be our last example. So we are going to measure off from this point to this point. You get? To this point. So the same thing. You get? The same thing. Let me draw this horizontal line. We can see that we have these candle wicks. So you can see that even before the moment we tapped into discount, the market started to buy. You get? The market started to buy. So basically, this is going to, so which means where from this point, if I'm buying, where would my take profit be? If you multiply, if you to use this length from this level to this level and you multiply it by 2, like you multiply it by 2, it means you're going to be, let's say from here to, let me quickly, you get, you find that target 1, you get, so at least target 1 can be there. You get? So basically in the next episode I'm going to be providing some sort of part 2 on the same. You get? But then I recommend that you guys subscribe. You can ask any questions because next I'm going to be talking about order blocks, but basically I'm going to be building on to what I've talked about in this episode. So basically, you can drop any questions in the comment section, or you can text me directly on Telegram. The link is going to be the description, so that maybe you can request me to talk about the things that maybe I've not talked about here, or some special things that you may want me to talk about in that next episode. But basically, there we are going to be talking about uh, it is going to be part 2 of this. You get? It's going to be part 2 of this, and then mainly we are going to be talking about order blocks. But order blocks is just a term that we use to mean supply and demand zones. You get? So for now, I wish you the best and peace.